when you have a diversified basket of securities, you may overpay once in a while for a company. You may underpay once in a while. Hopefully, you're underpaying more than you're overpaying, and that's typically what happens. But over the life cycle of the portfolio, you're going to see the math and market even out where the S&P over time is probably going to be worth anywhere from 20, 21 times forward earnings. Now, why do I say forward earnings? And this is what's really important to understand. Investors a lot of times look backwards. That's the biggest mistake you can make on the good side and the bad side. You could look backwards and look at a stock that trades for 100 PE, but if you look at forward earnings like Nvidia now, a great example of this, is actually going to trade at a much more reasonable PE once their earnings continue to come in like they have been. So if their earnings growth has been strong going forward, the stock's PE is going to drop. Their price that you're going to pay is actually going to be pretty reasonable. On the other hand, you could look backwards and you could say, oh, a stock looks like it's really cheap. It's trading for 10 times earnings. But in reality, their earnings are going to drop next year. Expectations are going to fall off a cliff. And then all of a sudden now the stock's going to trade for a 30 PE. And so that's what you want to be very careful of, is not just looking backwards, but really looking forward. And that's what markets trade on, is forward PE.